In this video, we are going to talk about foreign exchange risk within the financial institutions universe. And this is just overview, very broad, just a few key points on foreign exchange risk and issues within financial institutions, not an in-depth look at foreign exchange. Quick refresher about foreign exchange rates, the difference between direct quote and indirect quote. I would like to start by saying that a direct quote just means the domestic currency per unit of the foreign currency. So if you're in the United States, then it's US dollars. If you are in Europe, then it's euros. If you're in England, then it's the pound. So when they say here, direct quote, US dollars received per unit of foreign currency in exchange, it's assuming that you are in the United States. And then the indirect quote is just the opposite, the foreign currency received per US dollar exchanged. In this case, they're using Canada and the United States as an example. And that's why the bottom part of the slide is giving you that note that the terms direct and indirect depend on where the quote is obtained. So that's why it doesn't have to be United States. It just means domestic received per unit of foreign. So if you were in Canada, the examples they give there would be flipped. The direct quote will be Canadian per US dollar, and the indirect quote will be US per Canadian dollar in that sense, that the numbers will be flipped. So just understand that. Direct quote does not mean United States dollars, you mean domestic, wherever country you're in. Foreign exchange transactions. We got spot, foreign exchange transactions. Spot means like on the spot, whatever the exchange rate is right now, and you make the exchange, that's what you get, that market rate at the moment of doing the transaction. A forward foreign exchange transaction is when you are looking at the forward rates, which is future looking in that sense. Now, here's an example of the net exposure. This is the key part of within calculations within financial institutions, because the idea is, well, what is at risk in the financial institution? Remember, this is about a risk management. So exposure, it's one way to express how much risk is in the financial institution. So net exposure equals the foreign exchange assets minus the foreign exchange liabilities, or the liabilities expressed in the foreign currency. Then you add the foreign exchange purchased minus the foreign exchange sold. So it's netting. You're looking at the net between assets and liabilities expressed as a foreign currency, plus the net of any purchases and selling of this foreign currency. Just so this, for those that maybe are not aware, this will help make a little more sense of what I mean by foreign exchange assets. An international company, whether it's a financial institution or any other company that has entities in more than one country, some of the assets may be listed, let's say, in United States dollars, and then some assets may be listed as the currency of the other country, because that's where those assets are there. They're not being transferred yet. Cash is an example. Current assets, you have cash, right? So any cash holdings that are being held in the other currency have to be listed in that number. So that number is just the number of the foreign currency. But what does that mean in dollars? And that's what's important to understand. That changes. So your balance sheet could change, not because of operational stuff you did in the company or buying or selling anything. If everything stayed the same, your balance sheet can still change because the foreign exchange rate changed. So that's the net exposure. So talk more about foreign exchange risk exposure. The financial institution may have positions in spot and forward markets. Could match foreign currency assets to liabilities to hedge foreign exchange risk. So one way to kind of look at that first bullet that we're talking about, to match foreign currency assets to liabilities to hedge foreign exchange risk, it could be that, all right, if I have in my current assets some cash in the foreign exchange, then in my liabilities, let's say I also have employees, this is just a random example, we're simplified, of course, have employees in that other country, then I can keep the wages payable, add that foreign exchange currency, that foreign currency as well. That way, I don't have this problem having to convert before paying the employees. So at that point, there's no foreign exchange risk because you have the same currency on both sides. Now, it's not as easy as that to do all of them, but you can match the best you can to bring your risk down. And then there's other ways to deal with other differences you may face. Must also hedge against foreign interest rate risks by matching durations, for example. We're going to talk more about this a little later, but foreign exchange and interest rates always go hand in hand because they affect each other. Differences in interest rates between countries will reflect on the differences of the foreign exchange rates. And it's because they have to eventually meet this equilibrium. And as one goes up and down, it's going to manipulate the other one to go up and down too. For the details of how that happens and why it happens, that's for a different course. But just understand for now that interest rate and foreign exchange rates pretty much operate together. One will influence the other and vice versa. Financial holding companies have even greater ability to reduce their net exposure to foreign exchange risk. So because it's easier to match or it's not easier, there's more opportunity to do this matching of interest rates and foreign exchange risk on the balance sheet. So therefore, they're able to work that better. They have more. It's not that it's easier. They have more opportunity, and mainly because there's more cash involved. I wouldn't say mainly, but a big piece of it is because there's a lot of cash involved. So it's easier to match, or more opportunities to match. Foreign exchange risk exposure. So more detail. Greater net exposure in foreign currency combined with greater volatility of the foreign exchange rate results in larger potential for losses or gains. Okay, so the first thing that I want you to get out of that paragraph, that bullet there, that sentence, is that last piece, larger potential for losses or gains. This is the typical risk versus return that you always hear everywhere in finance, and you should be familiar with. The higher the risk, the higher the potential losses, but also the higher the potential earnings or gains, I should say. So it's no different here. So greater volatility, right there in the middle of the sentence, greater volatility. It's a keyword that when a finance person sees that, greater volatility means greater risk. Greater risk means larger potential for losses and gains. Okay. And that's what it is. So the net exposure that we calculated here is another form of risk. Of course, the higher this is, the higher the risk you have. Not a direct comparison, but just so you can get an idea. For example, a regular company, even if they're not international, the higher the fixed assets, the higher the risk of the company. The higher the debt levels, the higher the risk of the company. So volatility is not always only measurement of risk. So in this case, the net exposure, as you notice in the formula, is a matter of assets. The net assets after liabilities are taken out, and then the net foreign exchange purchase minus foreign exchange sold. The more you buy, the less you sell. Your net is positive. It's just increasing your risk. So the more foreign exchange you hold, the higher your risk. So here is the greater the net exposure, in other words, the greater this number, combined with a greater level of volatility on the foreign exchange rate, then each one of those are two different measurements of risk. So when you put it together, you get your total risk, and then you have that larger potential for losses and gains. But it's just another way to say higher risk, higher return, but also potential higher losses or greater losses. Okay, dollar loss gain in currency I. This is a formula. I know it doesn't look like a formula because a lot of words, but what they're saying is that the dollar, if you want to calculate your loss or gain in a currency, I being whatever XYZ currency, what you do is you take the net exposure that you know how to calculate now, measure in US dollars if you're in the United States. If you're not, you just measure in whatever domestic currency is, and you multiply that by the volatility to the dollar, the exchange rate, that the dollar over foreign currency exchange rate. So the volatility. And that's how you can then calculate what your loss gain will be. Trading activities. Basically, there are 4 trading activities. Purchase and sell foreign currencies to complete international transactions. So financial institutions, while they themselves may be involved in transactions, think of it also that there's a service they provide for companies, where there is a company that has entities in a different country and they have to then move money from one country to another. They're going to have to purchase and sell the foreign currencies. Or if there are 2 businesses, one in country A and the other one in country B, one of them too has to convert, or depending on the transaction, they both may need to convert. So the financial institutions can facilitate those transactions as well, specifically in very large numbers. Facilitating positions of foreign, real, and financial investments. Just what it sounds like, positions as in, let's say a brokerage company. Well, people can hold positions in foreign exchange, foreign currencies. Accommodating hedging activities. We're not going to go in too much depth in this course about how you can hedge in order to lower or prevent foreign exchange risk. But to give you a quick example, with a forward contract, we're talking about earlier about spot versus forward. And let's say you enter a contract with a foreign company, and if the agreement is going to be done in the currency of the other country, not your currency, then you might benefit by hedging. That way, if the currency the foreign exchange rate of that currency goes against you, it doesn't become more expensive when you have to make payments. Or if you're receiving payments, you don't lose money, because when you do the exchange, you may not get the same amount of dollars that you originally planned for. So what you do is you can enter into forward contracts with other third parties, not the people you're doing business with necessarily, and you lock in an exchange rate, meaning that regardless of whatever happens to the exchange rate, up or down, you're going to have the same exchange rate. So you can do that through a contract. Now you hedge. Now, always understand, this prevents any losses that you may incur in the future because of exchange rates going in the direction that doesn't benefit you, depending if you're making payments or receiving payments. However, this same note, if the exchange rate was to move in a way that it would have benefited you, you don't get that either, because the hedge then puts you still on that same fixed one, but it takes away the risk and the volatility. So it increases the value of the project, the net present value. And speculation. As you know, People do foreign exchange trading with no need for hedging or facilitating transactions or anything like that. They just want to buy and sell foreign currencies with the hope of making a profit and not going the other way. However, I must say this now: foreign exchange rate is one of the riskiest. Not foreign exchange trading is one of the riskiest forms of speculation. And the reason is because, theoretically speaking, you could make unlimited gains, infinite, because exchange rate can always become greater and greater, the difference. But that's if it goes in your favor. But because it can also go in the other direction, and it can continue going greater and greater, that difference, then that can also mean an infinite losses. So it has infinite losses on both sides. There's no way to say, well, go long, short, or any of those other fancy terms. If you go into the speculation game, you could have infinite gains, but also infinite losses. Both directions. Foreign assets and liabilities. This is a little more detail on the things that we spoke about earlier that had to do with foreign assets, foreign exchange assets and foreign liabilities, foreign currencies, and with that we talked about here about matching in order to lower risk. So when you have mismatches between foreign financial assets and liability portfolios, that increases your risk. Now, ability to raise funds from internationally diverse sources presents opportunities as well as risks. So now if you have access to, I don't want to use the word arbitrage, but when they say here, exploit market imperfections, if you have access to multiple sources, they're not always going to be perfectly aligned. There might be differences between their interest rates and their foreign exchange rates. So if that will be a market imperfection. Now, those don't last, but if you catch it, while there's an opportunity to make a few dollars. And when I say a few dollars, it depends how much you move at the moment. These things could result in higher return on assets or lower funding costs. Either way, it could go in a benefit when you find these imperfections, whether you lower your costs or you increase your return or a combination of both, it's a win. But this is not easy to identify or find them. And having diverse sources at the international level of funds, small people don't have that. By small people, I mean small entities. But it does exist as there. So the big players, like I say, can take advantage of these. So return and risk of foreign investments. Returns are affected by the spread between costs and revenues. That's I don't want to use specifically profit margin, but that's something. If you have high revenues but high cost, then your spread is small. So your return is going to be small. But if you have higher revenues and lower costs, then your spread is wider. Your return is going to be greater. Changes in foreign exchange rates can dramatically alter returns. So here's back to the matching principle. When I mentioned that even if nothing changes in the operation and the income statement, the balance sheet and all that, just by changing the foreign exchange rate, it can impact your income statement and your balance sheet and all the values and your cash flows for sure. So, but notice it doesn't say gain or loss. It just says dramatically alter. If the exchange rate goes in your favor, it dramatically alters it in a positive way. If the exchange rate goes against you, it will dramatically alter in a negative way. And important to know that the financial institution, or any business for that matter, does not control the foreign exchange rate. So you're at the mercy of the economic forces. And there it goes with similarities with exposure to interest rate risk. The financial institutions and or any company for that matter have no control over interest rates. And same thing, interest rates change, the value of your company can change dramatically. It could go good or bad, depending on your position. Risk and hedging. Generally speaking, you can do on-balance sheet hedges or off-balance sheet hedge. On an on-balance sheet hedge involves changes to on-balance sheet assets and liabilities to protect against foreign exchange risk. The matching stuff that we spoke about earlier, that will be an on-balance sheet hedge, aligning up your liabilities or not, matching your liabilities and your assets for them to be in the same currency. So it's a way to hedge it. And it could be just as simple as moving some of your cash in this currency into the other one, or bring in currency from the foreign one and bringing it to dollars domestically. Whatever it is that works, but it's just pretty much that matching idea that we spoke about earlier. Off-balance sheet hedge occurs via position in forward or other derivatives. This is the example. The example that I spoke about, a forward contract, will fit into the off-balance sheet hedge. So this, you do a third-party forward contract to lock in your exchange rate, and that way, as the future approaches, you're not subject to the fluctuations in exchange rate. Once again, you eliminate the losses, but you also eliminate any gains that would have brought you. You just you stabilize the cash flows. Hedging with forwards. Forward exchange rate is the rate agreed today for a future delivery of a currency. As we explained, you lock in your exchange rate now, but you use it later. Allows the financial institution to remove the future spot exchange rate uncertainty and other uncertainties related to returns on investments. As I said, you just lock in a price now, so you don't have to. This is no different than a farmer doing a future contract for their corn, locking in the price of their corn, so that when they harvest it, if the price went down in the market, then they didn't take that loss. But if the price went up, they didn't get the gain. They still have to settle for that price. But the not getting the gain, it's okay in the sense that you still got the money that you wanted to get to continue your business and get the profit that you have an expected profit. But if you leave yourself open to the potential losses, it can take you out of business. So here, instead of a price of corn, it's just the price of a currency. Multi-currency positions. Since the banks generally take positions in more than one currency simultaneously, their risk is partially reduced through diversification. Yes, if they have some positions in dollars, some positions in Mexican pesos, some positions in Japanese yen, some positions in the euro, some positions in the pound, since all these are floating rates and they all kind of interact in different ways, the potential losses of one get offset for the gains in another, and so on and so forth. Because they're not, you're not going to be in a currency. For example, your domestic is US dollars. If the dollar weakens against one country, more than likely it's going to be strengthening somewhere else with another country. It just depends. But the point is that it's not going to weaken against all currencies at the same time, or it's not going to strengthen against all countries at the same time either. Now, at the how much they weaken versus the strength, that's different, but it eliminates some of that problem. Real interest rate, difference between nominal rate and expected rate of inflation. Just what it sounds like. There's a nominal rate. If you take the inflation rate out, what's left is your real interest rate. Another way to look at it, real interest rate plus the expected rate of inflation equals the nominal rate. So that means that nominal minus rate of inflation equals real interest rate. Now, this is important to know, and the key here is that, or the key reason why this is here is because the inflation rate is different in every country. Also, their interest rates are different in every country. And these are the things that impact it. And as I mentioned earlier, this has a relationship with the currency in the sense of foreign exchange rates. So if domestic and foreign interest rates or equity returns aren't highly correlated over time, potential gains from asset liability portfolio diversification may offset mismatching risk. In a nutshell, what they're saying is, we said earlier, if you are not perfectly matched in your assets and liabilities, then you start taking risk. The more mismatch there is, the more risk. However, as it mentions there, if the foreign interest rates or equity returns aren't highly correlated over time, then you may enjoy some gains on an asset in your asset liability portfolio diversification that may offset then any potential losses from the mismatching risk. But this goes back to diversification. And it has to do also with those market imperfections we spoke about earlier. The more countries you have involved in your financial institution, then the more opportunity for market imperfections and you may have, or you may be able to spot. And that's where you get those gains from there. And it helps you with any other mismatching risk. A quick formula here, as we spoke earlier, nominal return equals real interest rate plus inflation. So it's the same thing they said here in words, but now you see it in an actual formula. Purchasing power parity. Okay, in equilibrium, this is important. In equilibrium, real rates of interest should be equal across countries. Not just the real rates of interest, but also the price of anything you buy, in the sense that, well, I mean, you may convert to a different currency, but the price should be the same. I'll explain this a little more in a second. Therefore, differences in nominal interest rates reflects differences in inflation rates across countries. So, since nominal is equal to inflation plus real rate, and when equilibrium, the real rates should be the same. So over time, it averages to the same. That means that what's different is the inflation. And that makes sense. Foreign exchange rates should adjust in response to difference in inflation rates. Here's the sentence that starts talking about what I mentioned earlier. As interest rates change, or as they change and they become either greater differences or smaller differences between countries, that's going to have a direct impact to the foreign exchange rate to balance out the pricing, the purchasing power parity, which is what we're talking about here. And notice there that domestic minus the foreign is the same as, well, the interest is the same as a change in the spot domestic foreign exchange rate divided by the spot domestic foreign exchange rate. The examples in the textbook will actually give you numerical examples so you understand better, but that's the parity. So one side has interest, the other one has foreign exchange rate, and they should equal. theory of the purchasing power parity should generally be applied only for long-term analysis. Earlier, we mentioned market imperfections, but they don't last. The point is that as foreign exchange rates fluctuate, as interest rates fluctuate, they don't catch up automatically across the globe. It takes time for it to work through the system and then balance out. Also, you might have short-term supply and demand shocks of the currency, et cetera, all kinds of things that may happen, even some behavioral practices that are nothing technical, that throw it off from time to time. That's where these market imperfections come from. Well, part of them. And the point is that over time, they do go in equilibrium. They average out to the equilibrium. They just may not be in equilibrium all the time. And that's what I say long-term analysis. Doing this in the short term, it wouldn't work. If you could find a way to do short term, you'll make a lot of money. But trust me, there's plenty of people out there looking for it. They just look for the market imperfections. It's better that way, which is easier. It's just there. It can take several years for parity to occur. And by several years, 7, 10 years, 30 years, it in economics, because this is an economic issue here. It's not really, in finance, we just need to know. The cycles in economics can be very long. It just depends what we're talking about and what other forces are out there manipulating or shifting and changing things as we go. So I say 7 to 10 years, that's like a regular business cycle. If you go to like a full economic cycle with an entire generation, it could be up to 30 years. It's just several years for it to, it will always average out. The question is not what's going to happen. What we don't know is when it's going to happen. Law of one price states that if the market is efficient, identical goods in different countries should have the same price. Now, you're probably thinking, well, this same thing in a country with a lower, let's say something in the United States, it's easy to see how it may cost a lot more than in a country with different economic conditions. One way to look at it, if you were to purchase the item and ship it to the United States, you have to include all the transaction costs and friction costs, any taxes, quota, tariffs, all that together for them to say, like, you see the same price. And this is how it works. So even if you could find something in a different country and have it shipped and be cheaper, eventually supply and demand economics will kick in. And that means that the prices in the United States will start dropping because people are not buying the ones here. And that's what also mean that it's not instantaneous. It may take some time, and it will just work that way. Look, people are actually going to order from another country and ship it because it's cheaper than buying it. And it happens all the time. That's why so much stuff gets shipped from another country. And then eventually either they lower the price in the United States or the product ceases to be produced and sold in the United States. Either way, the price in the United States, it's whatever that price was that you're able to get it from another country. Now, it's important to understand identical goods. Quality of a similar product may then breaks identical. So anything that is different, then it's not identical good, and the price will be different. Sometimes a perceived difference is what it takes. You can have two products 100% the same and identical, but the way they market it, there seems to be a perceived difference. And then that can also then give you a difference in price. Last but not least, interest rate parity theorem. Equilibrium condition is that there should be no arbitrage opportunities available through lending and borrowing across currencies which require that, and then you got the formula. Let me tell you what this means. Equilibrium is a key word here. Let's say the example I'm going to give is talking about no arbitrage opportunities. Let's say everything moves instantaneously, like there's no market imperfection or no delay in adjustments in foreign exchange and interest rates. If you were able to borrow in England, borrow money at, let's say, 5%, because that's the interest rates in the market over there. Money is being lent out at 5%. So you go borrow 5% in England. But since you're borrowing over there, what you're getting is pounds, the British pound. Then you convert the British pound to dollars and you bring it to the United States. And let's say the United States has a higher interest rate. And then you lend it out in dollars at, let's say, 8%. If the foreign exchange rate does not change from when you did the original transaction, then you can just get your 8%, convert back to pounds. You pay the other loan, the principal, and the 5%, and you get to keep the 3%. That will be the arbitrage thing. However, what happens is that the foreign exchange rate is going to have an impact on this. When it's in equilibrium, you wouldn't gain any money, because what would happen is when you borrow on the British pound for 5%, you're going to convert it for some exchange rate at the point in time in dollars. You're going to lend it out at 8%. And then when you collect your 8% in dollars, the foreign exchange rate is going to adjust to that difference. And when you convert it back to pounds to pay back, the exchange rate is going to work against you. So if the interest rate was in your favor, the exchange rate is going to be against you, to where you didn't really make any money. It would have been the same as by the time you pay back all the pounds, the dollars were not enough, or, well, just exactly enough to pay what you owe in England, and you couldn't make the difference of money. So whatever apparent gain on interest rate is offset by the loss in foreign exchange rate. That would be in equilibrium. But because it doesn't happen instantaneously, those adjustments to foreign exchange rate and interest, then there are those market imperfections, and some people are able to take advantage of those. But on the long term, as they said, the average does play out. This is the formula to see the equivalence. The whole point is that the foreign exchange rate and the interest rates are going to offset each other. That's what they're trying to show here. Difference in interest rates will equal the percentage spread between forward and spot exchange rates. And this is what it means, forward and spot. So whatever exchange rate today, because of that difference of 3%, let's say it's a year, everything is like measured in a yearly one. Whatever the forward rate a year from now is going to be the rate that offsets that 3% apparent gain. And that's what they're talking about here. Okay, that's it for this video. We will see you on the next one.